Okay, hello everyone. Welcome to our monthly webinar series. We will give it about 30 seconds here and get everyone logged in. DJ, how are you today?
I am great. How are you?
I'm good. I'm channeling my spring colors here.
Well, we need it, that's for sure.
Yes, most of our offices, all of our offices are in Oregon, and we've been having some pretty extreme weather this week for April.
Bizarre. Couldn't believe it.
Yes, I know.
But Portland had it was the first time in 85 years they had recordable snow in April. Yeah.
Wow. All right. Well, you know, anytime it snows in Oregon, my kids get super excited. So I think on Monday that we did not even know that the schools were on a 2-hour delay. And so they got there on time and had to go to school. All right, well, today, welcome everyone. We are going to talk about a market update. We've had a chaotic start to 2022. The first quarter is in the books, and we are going to talk about what's happening in the markets. And then we're also going to talk about behavioral finance. What is our reaction, our behavior towards what's happening in the market, a little bit about money. And ultimately, our mission is to help you become a confident investor during chaos. I would say that would be a good goal for us to have today. What do you think, DJ?
Yep. Definitely a good time for that.
Yes. So if you are new to us, welcome. We are Financial Freedom Wealth Management Group. The company was founded in 2001, and we are a comprehensive wealth management and planning firm committed to helping our clients improve their long-term success and pursue financial freedom. We serve retirees. We have a lot of retiree clients today. We're going to talk about how your investments, specifically tie into retirement, because I think really important. You need to feel confident in your retirement strategy. And when your investments are volatile, sometimes we don't get confidence from that. So we're going to talk about that today. Also, business owners, it's important as business owners to build your own financial future, because no one's going to do it for you. And so we help getting our business owners set up for retirement and building wealth in their company as well as outside of their company. And then lastly, helping people go through transitions, life transitions, losing a loved one, a divorce, all things that are hard transitions to go through. And so we partner with our clients going through those transitions and really help them through them. We have an amazing team. We have 7 wealth advisors pictured here, 10 support staff. They're not all pictured here, but we have a wonderful team, and we continue to grow and serve our clients. So today we have the pleasure of having DJ Wright with us. DJ is a wealth advisor and also our investment manager. DJ loves to discover and monitor our investments and also looking for new investment opportunities for our clients. He is instrumental in crafting the various portfolios that are used for our clients' investments. As a wealth advisor, DJ is passionate about serving our clients across the nation and providing guidance to help them pursue financial freedom. He received his bachelor's degree from the University of Oregon, go Ducks, where he focused on economics and business. DJ actually just got married in March and just came back from his 2-week honeymoon. He enjoys being outdoors. He's sports. You can talk sports with DJ.
Sports and investments all day long.
There you go. And spending time with his son and also Cecilia, his lovely bride. And I hear there's another special surprise coming.
Another little guy on his way.
And we know it's a boy, right?
We do. Yep. Another boy.
That's exciting. Okay, so at this point, I'll turn it over to DJ and we will get started.
Okay, well, thank you, Julia. Well, let me introduce you really quick. So Julia, she's our founder and CEO. She started this company back in 2000 over in Newport, Oregon on the coast. She does a lot. Okay, she does a whole lot. She runs the company. She's obviously a great investment manager, helping people with their finances. She's an author. She's a writer. She's a speaker. She does it all. She's amazing, and it's great to be here with you and to learn from you, Julia.
Thank you, DJ.
So let's talk about the markets. So there's lots to talk about, and there usually is. Right? There's usually something that we can talk about, whether it's good or bad. We can always find a lot to dissect in the markets. And it's one of those things where, the stock market is elation and then fear, and then elation and then fear. It's like a pendulum that swings back and forth. It's how it goes. It's how it's always gone. It's how it always will go. Right now, we tend to be in a fear mode, right? There's a lot of worries, a lot of negative headlines out there. And so we're going to give you, lots of info today, some of our views. And we're also going to look at how the stock market has reacted in the past to some similar situations. But it's important to remember that we can't predict the stock market. Nobody can. We certainly can't control it. What we can do is we can set ourselves up to handle whatever the stock market's going to do, knowing there's going to be ups and downs along the way, and there always will be. Generally speaking, the best way to handle it is to be well diversified with your investments, to have a good long-term plan and stick to it, and sometimes just to breathe, right? And Julia is going to talk more about that here in a bit. But let's talk about numbers and markets here for 10 minutes. So, as most of you have heard, interest rates are going up, right? We saw our first rate hike in March. So the Federal Reserve, or also called the Fed, they're our central bank, and their job is to keep the US economy growing at just the right pace. So not too hot, because that can be a problem with inflation, which is what we're seeing right now, but also not too cold, like we saw back in, during the pandemic, those early months. So they want that sweet spot, and they have a lot of tools that they can use to keep it moving at just the right pace. They've had rates really low. And think of interest rates as, when they're low, it's like easy monetary policy, and it spurs economic growth. When they start to raise rates, it's like pumping the brakes on the economy, trying to cool it down so that inflation doesn't get carried away. And so they've started that process, and it could take a while, but we saw the first rate hike. There's going to be several more this year. A lot of times people think, okay, rates are going up, that means stocks are going to go down, right? It's going to be terrible for stocks, they're going to crash. And that's not necessarily the case. Yes, it can be a bit of a headwind, but when we look at past rate hikes, when we've gone through those periods, it's actually been pretty good. Stocks have fared pretty well. So this here you can see it's kind of the short term, within a year reaction of when we first start raising rates. So when you look at 3 months out from that first rate hike, the average return to the stock market, the S&P 500, has been 0.7%. So basically flat, a little bit up, but it's been positive 50% of the time. When you look 6 months out, it's been a little bit better, right? You can see the return's been much higher, and it's been up 75% of the time. When you look a full 12 months out from that first rate hike, positive, or on average, the market has gained 9.2% or been positive 87% of the time. So again, history shows us that stocks can actually do pretty well when we start raising rates. This next slide, we're going to see that kind of the full cycle, right? So that last one was really just within the first year. This is the full cycle. So when we look past interest rate, raising cycles, on average, these can last maybe a year to a couple of years. You can see, the date of the first rate hike, the last rate hike, the starting federal funds rate, what we ended with, what we got it to, the total number of hikes, big ranges, right? Sometimes look at 60 rate hikes in the 70s and 80s, which makes sense, right? That was a high inflationary decade. And so they were really trying to get that under control. But it can also be shorter. There'll probably be quite a few during this cycle. But when you look at the S&P 500 return during the full cycle, the average return has been 11.1%. That's pretty good, right? Or when you look at the actual percent of the time it's been higher 72% of the time. When you look at annualized returns, you can see it's 4% per year. So I wouldn't expect us to be 30% higher, right, in the next few years. But we could be, modestly higher. Stocks could still fare pretty well, even though we're going to start raising rates. The other thing to think about is we're raising rates because the economy is growing, right? It's growing fast. And so there's a lot of good in that as well. So this is a great chart right here. You can see the most important chart in the world. We've just seen a stock market correction. So a correction is when we pull back 10% from a recent high. It's never fun. It's never easy to go through a stock market correction, absolutely. But it is normal. On average, these things happen about once a year. So this, you can see it's year by year, and the blue bar is the actual return for the year. What the S&P 500 returned from January 1 to December 31st. And when you look below these bars, you see the diamond. That's the biggest pullback that we saw during that year. So let's look at 1980 here. Well, we returned about 25, 26% for the year. But if you still look at that diamond below it, at some point during that year, we pulled back 17%. Right? So it's a big swings. We can see big swings. And if you just pick any year out here, you can see that generally the market did pretty darn well for the year, but we did see a pullback along the way. The average pullback has been 14.2%. So again, we expect these corrections of 10% or more. It doesn't mean that the market's going to stay down there. A lot of times it's short-lived and then we recover and we move past it. Could you imagine that if, let's say, you panicked and you sold on all these pullbacks? I mean, it would be catastrophic to your portfolios, your investments. You just got to stay the course and know that there are going to be ups and downs, and that's okay. And make sure that your account can handle those situations and stay the course. Here we can see coming off of a correction. So again, a 10% pullback, what the stock market historically has done after that. So there's a whole bunch of them going back to the early 80s here. And when you look kind of on the right of this chart here, we look at the average return 1 year later, almost 22% coming off the bottom of it. So typically what we've seen in the past is when we go through these corrections, the markets come back pretty quickly. And when you look 2 years after the lows, it's been up on an average of 36.5% coming off that 2 years later, or it's been up 85% of the time. So those are pretty good numbers. I'd stick with it, right? We don't want to panic and let fear take over, right? Eventually we're going to be back to elation. It's that pendulum going to swing back. So of course, a big thing and a big reason for some of the the stock market troubles and just everything that's going on is the conflict, Russia and Ukraine. And it's terrible. Sometimes I don't like talking about the investments in the markets when there's some people are dying over there. So I'm certainly not discounting that at all, but I do think it's important for us to look at what's going on with the U.S. economy as well, and how past geopolitical events have affected the U.S. stock market. So a whole bunch of events, right? You look down this list, a whole bunch of them that have happened. And what this chart is showing is, well, what was the total drawdown from those events? So you can see there that on average, the total drawdown's been almost 5%. So the stock market will certainly react to situations like this, but fairly modest pullbacks, right? About 5%. And then we can see at the end there, the days to the bottom on average has been about 20 days. And then how many days it took to recover those gains, on average about 43 days. So really what this chart is the goal of this chart to explain is that it's usually short-term reactions. People are reacting to things. It's usually not going to have a huge catastrophic issue with the US stock market, and it's usually going to recover fairly quickly. And so we're a couple of months out from when this started. I believe we're actually fairly flat since when this did start. We had already actually been going into a correction mode, getting close to it before this. And so it's not, we haven't seen a huge pullback from all of this. Now we'll see how it what happens going forward, but the stock market is resilient. It really is. The US economy is resilient. And that's just kind of the quick update that we have for you guys here. Again, lots going on. A lot of it is fear and worries, but there's not always a need to worry. It's going to be okay. And Julia is going to give you some great tips and advice now about how you can handle some of these worries.
My feeling is I need to say easier said than done, DJ.
You are absolutely right. You're absolutely right.
Yes. I think going into this year, the big headwind has been inflation. And then you add the Ukraine-Russia crisis kind of on top of it, and you saw that kind of immediate drop. And then it actually did recover a little bit from that low. It's also interesting when you zoom into the charts of this year, when the Fed raised rates 0.25%, the market actually liked it. The stock market came back up because it's certainty. It's like, people were wondering, are they going to raise rates 0.5%, 0.25%? They ended up going with 0.25%, most likely because of the geopolitical event happening. But when the market knows what's going to happen, it will respond and like it. So, and again, the market is very forward looking. So today is the first day of earnings season, and we've had good companies coming out reporting good earnings. Some airline stocks have said, hey, we're going to have profits again. Imagine that. So you see there's good news, and the market has responded favorably to that. And so I think as we get more into this earnings season, we're going to see the impact of how inflation is on the earnings of these companies. So at the end of our webinar today, DJ and I will stay on. We'll take some question and answers. So as we go through this, if you have questions, please use the chat or the question feature, and we'll make sure to get those answered at the end. Because there's a lot of things around inflation, that we can still discuss. And it's important that we do have a very watchful eye on what's happening with inflation. So as Jason, or why do I want to call you Jason today, DJ? So as DJ, talked about all the reasons why we shouldn't have fear based on historical information about how the market is resilient and does overcome these events that happen in the market. But here's the bottom line is we're still going to have anxiety around it. We're still going to have worry. We're still going to look at our statements and see the values down. And as much as we can tell you, oh, don't worry about it, we're still going to worry about it. I worry about it. It's a normal reaction to losing money on paper. We'll say on paper, but this war, I think, a lot of those historical geopolitical events that we showed you didn't happen in a time of social media and the internet, where we can actually transport ourselves into that country and experience what's happening right there. That the headlines, it instills fear in us. And I think that there's good and bad with that, but but I think it also just creates this much more real experience that's happening. The headlines of gas prices. I have a headline here I want to share, and tell me how we react to this. Gas prices are already expected to top $5 a gallon. We saw that, but experts lay out a scenario that could be much worse. Now, how does that make us feel? That doesn't make us feel very good. And so again, it's okay to have these feelings. And it's very natural. And especially when the swings of the markets and everything's happening. But I think the common impulse is to take an action or react to that. And that's what we want to step in here and say, if you actually take an action to sell or to make a lot of changes in a period of volatility or when the market's down, it is proven time and again to be disadvantageous, I can't say that word, for your long-term financial picture. So saying all of that, the big question is, so how do we get out of the chaos? That's different for all of us, right? It could be for some of us, we just don't watch the news. It could be for some of us, we want to know what's going on, but then we just want to be aware of how that's impacting us. And a lot of times, if you have that awareness to how this is making me feel and acknowledge it, like actually putting a name to, oh, that's making me worry when I do that, and just have mindfulness around it, that helps us start separating from the chaos. DJ presented a lot of really good statistics and things that can give us this confidence. But the very next tomorrow, if the market's down, that confidence can be temporary. And so how do we have more of a long-term peace or a long-term confidence in our investments and specifically to our finances? So we feel it kind of begins with a desire to have that, to be willing to see things differently or to think about things in a different way. Like what DJ just presented, there's a lot of historical facts that support that we are just in a time of chaos. We're in a time where the headlines are going to the market's going to react to this. But as we've seen, we have overcome this in the past. So I love talking about kind of these steps to feeling more confident. And I'm going to apply this to finances, but I think we can apply this to any aspect of our life. And number one is that desire, or what we want, or what is our outcome. So if we say our outcome is financial freedom, and that means you're either in a position of you're building your wealth, you're in that accumulation mode, or maybe you're in retirement and you're taking money from your investments and you want to think more, not really build, but protect the wealth that you've built. So I think in two different scenarios, we have the accumulation mode and that distribution mode clients that are with us today. So I think what I would say if you are in that accumulation mode is looking at times like these as opportunity to get excited about buying investments that are on sale. The stock market is one of those things where when it goes on sale, there's not a rush to go in and buy. So if you can train yourself to think about, when the market's down, it's actually a good time to put money into the retirement plan, add to your Roth IRA, and over time you'll benefit from doing that. So once you know what you want, that outcome, the next point here is to make a decision. So to decide is to cut off all other options. So it's to decide that you're not going to let these short-term market fluctuations influence your decisions, meaning you won't sell and put the money into cash where it has no chance of making up money and, making your dreams and goals in your retirement come to fruition. Because when you sell when the market's low and then put it into cash with interest rates at, still very low, it would take a lifetime to make up what you could make up very shortly as the market recovers. So again, that decision is that commitment to cutting off all other options and really sticking true to your long-term financial plan and not making any other decisions against that. It's kind of like if you're riding a roller coaster and you're upside down on the roller coaster and you decided you wanted to get off at that moment. You wouldn't want to hit the eject button. You have to kind of stick with it and commit to that choice that you made in a moment of probably a lot of clarity, a plan, a well-designed plan that was for your best interest in your financial future. Next is determination. So when you have the decision and a hard challenge comes at you, like we're in right now, it's that determination in the moment of the fear and the worry. And that is when the determination is needed. It's that courage to stay the course, the courage to listen to wise counsel, the courage to trust us if you're our clients. Determination is that firmness of purpose in your legacy, in your long-term wealth plan. And if you're doing all of these steps, it lands you at discipline. And when you have that feeling of discipline, it's essentially you've done this over and over again. So you essentially build a new capability, new experiences, new habits that support your desires. It ultimately lands you at confidence. And I have this thing I keep by my computer. I don't know if you can see it. Can you see it, DJ?
It's a little small. Oh, discipline is freedom.
It says discipline is freedom. So when you have a discipline, it ultimately brings you to that feeling of freedom, feeling of financial freedom. So when we manage your investments, it is not by, wishy-washy decisions or a feeling. It's actually a discipline, a science. It's based on historical results and lots of research that goes into it. And that discipline is ultimately what gives us confidence in your strategy as we go through times like this. So this picture, we thought it'd be beautifully represent. It's actually of Newport. I can actually see this bridge right a little bit out of my window here. And it's a sense of peace. DJ said when he saw it, he wanted to go fishing. So maybe, okay, we can go fishing and have freedom out there while we worry about your investments. So as we recap, we want you to be a confident investor. Recently, we wrote a piece for Forbes on this, and we're actually going to share that with you in the chat. So you can actually click on the link and it'll take you to the Forbes article. And that'll just, it's a lot of what we've talked about today. And to recap that, resisting emotional decisions, or at least like DJ said, taking time to breathe and pause. The volatility and uncertainty in the world and the stock market can be tough for investors, for all of us, especially if you're retired. We do not take that lightly. We understand the responsibility of managing your money when you're not going back to work and you're not when you're not going to get more. And that I just wanted to hit on that because I think it's more emotional if you're in retirement going through the markets like we're going through. And again, the common impulse is to sell, due to these fears and the emotions. But as we've shared today, historically, this is disadvantageous for most long-term investors. And historically, the stock market has bounced back, and we don't feel like this will be any different. A confident investor will act according to reason and statistics and logic in light of the downturn. So I wanted to share this because this is a really good chart. Not too long ago, a little over 2 years, we experienced the fastest recession on record, and that was due to the pandemic. So you can see the drastic downturn there. And we call this a V-shaped recovery because since the downturn, it was really only a couple months that it took to get back to highs. And then we just had this really great period of great market returns. And it was not volatile during that time, and a little bit, but not anything like it is historically. So in the moment though, that the market was down, there was fear. There were, we all felt like, oh my gosh, what's going to happen? But I hope this chart again brings confidence that it's time and being patient that the market rewards those investors. Empowered investors, we like to say, are educated. So attending webinars like this are really helpful because you kind of get our take of what's happening. Working with an advisor that has the experience with the ups and downs and the investments can partner with you to number one, understand what risk profile you should have in the beginning as an investor, but then when things like this happen, partner to listen and understand the concerns and maybe make small tweaks. Left to your own demise or our own demise as humans, we tend to make black or white tweaks, like go all to cash, where it could be where you just need to make little tweaks to be a little bit more conservative that will help mitigate the risk, but also leave you in a position where you can participate in the upside when it happens. Also, as investors, it's important to accept the current market trends. So understand the investment experience has ups and downs. It's kind of like life, right? We have the good and the bad. And it's part of flowing with all of that allow you to participate in good long-term investment returns. And again, the more experiences that we go through as humans, the more that makes us better. The more we can learn and understand how, like going through this right now, if you're really concerned and worried about it, then the next time we cycle into making money, again, I would say that's a time to reevaluate your risk. You're like, I wasn't okay with going through that, so I need to be more conservative and make adjustments. Or it could be where you're in that accumulation mode and said, I need to see that as an opportunity next time. If I look back over my investing, I've been an investor for almost 30 years. I started investing in the mid-90s, and I've been through lots of market ups and downs. And it probably took me at least 3 of them to know that those are opportunities and times to invest when the market is like it is right now. And, I would say I would have regrets, plenty of regrets to say I didn't invest when the market was down, because I succumbed to the fear and like the what if scenarios. That's very natural for as our human behavior. And so as we go through though, and have more experience and take the learning from that, we can have faith moving forward that the markets are resilient, that, we human race is resilient. We will get through this, and better times are ahead. Okay, that was a lot.
That was good.
So what I'll do is we have some questions, so we'll get to those. But before we do that, if you either are a client or you are new to us and you want to sit and talk with an advisor, it could be about your investments, it could be about financial planning. we would like to extend you a complimentary consultation. If you want to get out your phones and text the word freedom to 458-777-4458, that will prompt you and you can schedule that financial review with one of our advisors. We just have found that this is extremely valuable, whether you're a client to just touch base, if you haven't done that recently, or if you're new to us and you just would like to have specific questions about your investment portfolio or financial plan. We are partnered with LPL Financial. They are our broker dealer. All of our 7 wealth advisors, their securities and their licenses are held with LPL Financial. And they are the largest independent broker dealer in our nation. So we've been partnered with them since 2009. It's been a great partnership. And then at this point, we'll take questions, but I also have to put this disclosure page in case you need an afternoon nap. You can read through all that. But very good. Okay, so let's look at some questions. So just a comment, if you are sweating and experiencing anxiety when filling up your car with gas, that means you have car owner virus. That's a good one. That's from one of our clients and he's funny. So, all right, we'll get serious here. How do I have a long-term view when I'm 65 and don't have a long time to invest? Very good question, very common question. So I would say I'll give a little bit of feedback and then DJ, you can add to it maybe?
Yeah.
Okay, so I would say, number one, was sometimes when we think of 65 or we think of retirement, it's like, it's that, okay, we got to make a drastic change in our investments. But actually at 65, statistically, you probably have another 20 years, depending on your personal longevity history, but left. And so you have to look at your individual investments and net worth and your goals to say, how much money do you need to live on in your retirement, balanced with the desire to leave a legacy and leave assets to the next generation. We have clients that want to spend everything in their lifetime, and we also have a lot of clients that do want to leave assets to the next generation. But I would say anything over 7 years would be considered long-term. When we know in 2008 in that what did they call it? The Great Recession, I think. That was 3 years. So if you were in 100% stock portfolio, it took 3 years for you to make your money back and start earning again. So 3 years is relatively shorter term. But I would say that it's a balance of looking at how your picture puts together, because ultimately, if you don't feel like you have a long time, and you need this money over your lifetime, then it should be invested more conservatively. Do you want to share?
Yeah, you're right on, Julia. And like you kind of mentioned, it's really about your income needs from the account. That's really the biggest piece, I'd say. And hopefully we do live long retirement lives. Hopefully we are living into our 80s or 90s. And so some of that money, right, assuming you're not going to spend it all in the next 3 years, is long-term money. And so you can treat that like you maybe were treating your money when you were 45. But of course, because you are using some of it, you can't be fully aggressive. And so there's a balance, right? There's like a sweet spot to have some invested for growth and some conservative so that you're safe. And we can help you figure out that sweet spot. And then also, I think the long-term thing is also, try not to get caught up in the, what's happening right now, right? You don't want to make those rash decisions. Like, oh, the market is down 10% right now, I have to get out. Try to think a little bit longer term in that sense, knowing that there are going to be times where the market is down, but the market has recovered 100% of the time. When you look at the last 100 years, think about all the stuff we've gone through in
Yeah.
our economy, our world, and the markets have recovered 100% of the time. And so try to keep that in mind.
Yeah. Good. Okay, another question we have is, what if you've been planning to take some money from your account in the next month and a half, completely unrelated to market activity, and the need to do that will not change? Is there a strategy to employ that has the potential to minimize long-term loss? Ooh, very good question. I think it'd be interesting to DJ I think maybe an answer to this. There have been pieces, if you look at your portfolio, if you're a client of ours, there are parts of investments that have done, I don't want to say really well, but they've kept up in this market environment. And so more value-based companies tend to do well in inflationary periods. The super high growth innovation stocks, those are the stocks that kind of get hit the most from inflation. But on the other side, they're innovating, and over the long term, we believe that they will be good positions in your portfolio. So you don't want to abandon and put everything into value. You want to have it balanced out. But in a situation like this, where you have to take money out of your portfolio, there's a position in your portfolio that will be better to take the money from. And so working with your advisor to understand, okay, this is the best one. That's part of what DJ does for us is when clients need money, he actually decides which is the best investment to pull from. And that way that minimizes that long-term loss. Do you want to share more about that, DJ?
Yep. Yeah, and that was right on. Again, it's the diversification. That's the importance of making sure your account is set up well diversified beforehand, which that's what we do for our clients. And like Julia said, there's always an investment that we can pull from that's usually doing better than the others. And that's intentional, right? We intentionally pick different types of investments, well diversified investments that move in different ways, that are not likely to be negatively affected by the same economic condition. That's really what diversification is. And so you're fine. You can take that money.
Yeah, good. Okay, any other questions? You can put them into the box. Good questions. So one question we had was around mortgage rates. So mortgage rates have gone up recently. We've seen high fours. I saw a headline this morning saying 5%. So have the question is, is it too late to buy that home now at that new mortgage rate? Have I lost the opportunity?
Well, not necessarily. Again, these things are hard to predict what's going to happen. But what could happen is if rates are higher, we could see, less demand for homes, and it could bring the price of the home down. That's a possibility, which could help offset that higher rate. So I wouldn't say no, it's not all lost. And the other thing is rates are going to keep going up, right? We've kind of just started this process. So historically speaking, 4 or 5% still pretty darn good.
Yes.
Compared to what we've seen.
Yeah, I would add on that I think that what we see in housing is a shortage of supply. And so that's where if you have rates going up, that may help with that, where people wouldn't be buying, or maybe they're okay in their house now because they don't want a higher interest rate. When it comes down to it, talking about behavioral finance, if you want to get the new house, or you want to, maybe you're a millennial and you haven't gotten into the housing market, you're going to get into it. That's the American dream, is to own the home. And so, whether rates are, 5% or 3%, the desire to own the home, I don't think will go away.
Someone just
Uh,
said when they bought their house in 1999, the rate was 9%.
wow. Yeah.
Yeah.
I would say on the other side of that, I mean, I remember when I worked at the bank back in the late 90s, the money market account, like you could go to the bank and get a savings money market account for 4 or 5% interest. So, I mean, it's bound to I mean, it's time for it to swing, this other way. We have been in a low interest rate environment for 20 years. And so I think when you have a long-term period where the inflation's been below the norm, we're going to go into a period where inflation is above the norm to kind of average back out to where it needs to be. So I think right now, all eyes are on the Fed and there's a lot of pressure on the Fed to get this right, frankly, you may hear the term soft landing. That's where they don't raise them too fast, too high, too fast to put us into a recession, but they also need to do it somewhat to get a handle on inflation. So a lot of economists are coming out now saying we've probably seen the peak. Maybe one more month of an 8 to 9% inflation number. I mean, the one that just came out this week was, I think, 8.5%. That was I think the highest inflation number year over year since 1981, I think. So again, we're in a period of time, though, it's not normal. We were shut down for 2 years. And so, it has to balance out now the other way. All right. Well, I think that is all of our questions. Thank you so much for tuning in with us this month. We'll look forward to being back in May and bring you another webinar then. Any last thoughts, DJ?
No, it's fun. Thank you so much. Thanks, everybody.
All right. Have a great day.